Hello and welcome to the new fundamental review of another securities. So today we are going to review the Nike. Nike is a very famous brand. So as you can see on the screen, I have listed the 10K form of the Nike, and I'll go to the as usual. I'll go to the fundamental review. The last time I went to the Facebook, and hopefully you like it. And if you haven't seen that video, so I'll suggest, if you like the Facebook company or still making the opinion about it, if and you want to see how I did the fundamental analysis on the Facebook, please go ahead and watch it. I'll put a link somewhere here and right there, or let's get started without further delay. Okay, so let's me share something. So what is the total return, right? So what this company is giving over the many years. So this is my data, and based on this data I have plot this graph. So this is the Nike, as you can see, and this one is the footwear. Actually, it should not be footwear sector. Okay, as compared to its sector, how it's performed. So you have seen the footwear is in blue and the Nike is in blue. So in this year, for sure, every security is not doing well. Until so far, so this security is down 13%. Okay, so if you think comparatively from other interest, the securities, some are 40% or lower. So it is down for sure. It follows the market as well, but it's not down. It's not down that bad as well. So think from that perspective. One thing I noticed there is, look at the return, right? It's 3-year return is 17.42%, 5-year is almost 13, and 15-year is 16 to 17. So if you do the average, right? So if you want to keep, if I am thinking to keep holding the security, right, for usually when I bring this now, when I'm seeing that security, any security, I'm also thinking from that perspective. I don't want to withdraw from my portfolio 1 year or 2 year. I just want to keep for 10 or 15 years. And so that's why, although there are many other footwear there, and I picked Nike as well, but this is not just by the Nike. I mostly goes by the fundamental analysis, and this has a history as well, right? So these kind of questions I am planning to add, whether this will make it good for my long-term portfolio vision or is not, right? Because right now, there, as you know, there are so many securities out there which is cheap. So we, as a consumer or as a buyer, right, or as an investor, whatever, long-term investor, I have to be very careful where I put my hard-earned money. So without further talk, so this looks very promising, not bad. Okay, okay. So the next one is, let's go to this. This is the 10K, and let me show you the 5. Okay. One more important point I find about this, in last 2019, the company did a lot of security buyback. Okay, and the average is this 10.5 million securities they purchased, their own securities. So this means company is thinking they will do in future, and they are doing good. So that's one of the good positive sign I find. So this is the two signs I already find. So the first one is they are doing very good in the long terms. Of course not, and I show you earlier with the in the Excel pivot and Excel chart, and they also buying back. So that's another good sign. This mean this is, and third thing, this is also the dividend paying securities. Okay, so that's another bonus. So not only it's give the price return when they buy back, but it's also the dividend paying, and the average cost is 84.69, right, which is right now, even the share price in the market at this year right now is going around that. So that's the second point I like to capture here. Let's see now it's financial, right, where the more cream is. Okay, so this is, oops, I still get it. Okay, so this is my selected financial data in the 10K. You can see here the 2019 to 2015, the 5-year trend is there. Okay, in 2000, so let's see how they are behaving. So when I see the revenue, right, it's pretty consistently increasing, starting from 32 and going 30. It's not increasing that much, but it's increasing. And look at the gross profit is 40%, above 40%, and it's pretty consistent actually, and little bit improving. So it was up and down and up, but it's around 40-45, within that range, right? 45 to 46%, which is very good. Net income is increasing. This year it was down. I'll show you why it's down. Actually, in 2018, even I find during in the Facebook as well, the US did the tax law changes, and many companies have to pay taxes. Facebook paid it, and I think they also had paid that a lot. So that's why the revenue is down here. Earning per share, if you buy one share, how much you will get? So you see is quite good. It's $2.55. Even in diluted term is 2.5. It's very good, right? And dividend per share, they are pretty much giving $1. So 3.55 you can think you will get for the share purchase price, right? Okay, the cash, which is the cash is the king. See from this one, this is also consistently increasing. Short-term investment looks good. Inventory is okay, not bad. Okay, I'll do deep dive analysis, and then look at the ratios, right? The return on equity. So the return on equity is 42%, right? This is way good. It was dropped here. I'll also show you why it's dropped, but we'll also go deep, right? What makes this return on equity? Why this is 42% so high, right? And return on assets is 17%. So this is also very good. So return on assets means how much return the assets is generating, right? 17% is good. It was dropped last year, but it's pretty consistent. Okay, the current ratio is also is good, is above 2. Basically, this means right now, right kind of a situation where the companies need a lot of liquidity. And I also show you the other cash ratio, the quick ratio, which is a little bit more conservative, and how good it is. So okay, we'll also look at, but from the high level, from the current ratio, from short-term liquidity perspective, it looks good. Okay, so this is from here. So let me bring my spreadsheet back, and we'll go a little bit more deep down. So now we'll see here. Maybe I'll make a little bit bigger so easier for you to see. Okay, so the revenue growth is 6 to 7% consistently. Okay, and okay, I take percentage here. Okay, and the cost of goods sold, they're trying to manage to decrease it, so which is pretty good. So this means 1%, if you can think from that perspective, right? So the cost increases and also decreases, and the revenue increases. So it's win-win situation from both sides. So this means the management is doing pretty good job in increasing the revenue and also decreasing the cost. Earning per share is pretty good. Last year it was a negative, so maybe that's why you see here the PE jumps to 61. Actually, I'm not sure how it jumped that much, but because maybe their earning is so low, but the growth rate shows it's pretty negative. because the earning was pretty low. Okay, so let's do the the return on equity, right? So you see it's over 30% consistently, but this year 2018 it's slow. And when I did the check on that one, if you notice the profit margin here, the profit margin was in 16 and 15 it was over 10%, and in this year it is over 10% as well, but it significantly dropped here. Maybe I'll highlight it right 5.3%. And the reason for that is, you see the tax burden, right? There is a lot of tax burden, so they paid a lot of taxes. Maybe there's a lot of taxes due, so that's one of the reasons. Okay, so the good thing is, the bad thing is they have paid the taxes, but good thing is they don't have to do that much this year, because the effective tax rate because of that was 55%, and this year is only 16%. So you see that's immediately increase the net profit and also reduce the tax burden, right? One thing on the financial leverage, I don't like it. This one I like to point out, so that's why. So this means, if you notice here, the shareholder equity is only 9,000, which is almost 9 billion, right? This means they have a little bit more debt there. So this means they're also increasing. In the past, it was quite basically they're increasing more debt, right? So now if they're increasing more debt, so this means that's why you see the shareholder equity is so low, and we got 0.2.65, 2.62. This means almost 60%. I did a math on that. So 60% is their liability and almost 40% is around that ballpark, rough park is their equity, which I really don't like it. But the good thing I find it, they did the share buyback plan. Okay, so let's focus on other metrics. Okay, so I'll hide this one so you won't get distracted. So let's open our another, unhide it. Okay, so this is the cash current ratio, which you know is current asset divided by current liability. And quick ratio is basically all those actually maybe I have, okay, yeah, this is a little bit basically take out the one more, little bit more conservative, right? So which is even better. So you see here, this is over their liabilities, not bad. But the pure cash ratio, right, which is the just the cash and marketable securities, is less, even little less to cover their the current liabilities. But good point here is they have some free cash flows. Okay, so that's make it. But as the immediate cash flow is only 60, almost 60% to cover that, which is a little bit not good, but it covers because of they have a free cash flow, right, in hand. Okay, so let's take this one. Okay, so before I go here, maybe I'll show you some other metrics. I don't want to, or maybe I'll cover that. Okay, let's cover. So we'll finish this step, right? So when I did their cash, how much cash they are growing, right? Because no matter how much revenue you are growing, if you have not have a cash, it doesn't make any sense, right? So the cash generating from their asset is almost 30%. And if I remember correctly, the Facebook was 33 or some percent. So it's pretty good actually. The 30% they're converting into cash. Cash flow to debt ratio is 0.46. It's a little bit lower, but still not bad. If I do the price over cash flow, the ratio is coming 24. And the cash flow yield, how much cash the company is generating, is 6%. Okay, so that's what I'm getting. I did also the intrinsic value, and I found that a little bit even on my conservative side. And if I want to hold that security, I find right now the share is a little bit based on that, my value is higher than what is in the market right now. So from that, the company looks good as well. Okay, so let's go to the another one. Okay, so now when we see the trends, let's see one more factor which is very important for me. I don't want like a concentrations of the revenue. Okay, I, although I know the Nike is a good brand, but does it justify? Are they doing the good job to diversify in from the revenue perspective? So let's see from there. Yeah, before we go there, this is also a very good point. I'll so the management. This is MD&A item 7. I'll post this link as well so you can follow them and read. So the return on invested capital is low 30%. So if you invest your hard-earned money, so how much return you can able to get. So so that's what the company is doing. And also one good thing I like about it, their objective of doubling the impact of innovation, increase of speed to market, and growing our current direct connection with the consumer. Okay, so this means they are working on the strategy to sell directly to the customers. So that's very good, because if there is no middleman, this means they will increase their margin, right? And their goal is to through fiscal year 2023. So I like that point. And also I like it that the return on investment capital is 30%, which is way good. Okay, let's go to the item 7. Okay, so if you see the revenue, how from where the revenue is coming, so the Nike brand they have foot, apparel, equipment, and global brand divisions. So it's doing pretty well if you see from major perspective, right? Global brand divisions is doing minus, it's not doing that well, but overall is doing well. Okay, so sale to the wholesale customer is increased from 4 to 6%. But here you notice the sales Nike direct is decreased to 2%, right? This is fiscal year as compared to 2017, right, to 18. But they are planning to increase that, right? So they're planning to increase that. And if you notice in 2019, it's get increased. So it was 23, it went, it was way above, and and this is excluding the currency change, right? So, and they are, oops, sorry, and this is to the wholesale customer. Sorry, we were looking this one. I got distracted. So from 15 to 13. But if you notice in fiscal 2019, it come back. So this means their policies is making sense. And one thing I also like it, the Nike kids, right? If you notice, it was 1%, but it increased to 8%, which is this been good. So if kids at the early age they adapt the the Nike, this mean when they grow older, they hopefully they maintain the same habit. And for sure, we also use Nike. I also use Nike products as a shoes. I like their shoes, and it's one of the global brand product. And then they have some diversification based on the different sections even further, right? This is where I want to see as well that right now their focus is on Nike direct selling is only 32%, which is not bad as compared to 68. So, and they also want to increase this pie, so they will get more margin here, right? And they show by different footwear and equipment, which doesn't look bad. Gross margin, you see, this is 14.3 to 44. We see in my earlier trend, which is increasing. Okay, and let's go next. I want to show you, and then they have a breakdown here. Looks good. So in the Europe, Middle East, and Africa, you see it's pretty increasing as well. It was 7.9 billion, and it goes to 9.8 billion. This means they're doing good in, especially if they could do better in Middle East and even Africa, right? It's doing well. China, they are into the Chinese market, and where the population is the boom, so they're showing separately as a greater China markets. So it seems like they're also you see the growth here, right? 20% to 31%, right? 11% growth, and I hope if they continually grow there, so this will impact, because Chinese market is huge, and they also prefer the luxury products, right? America for sure. I'll show there. In North America, if you see the earning before, is not that great. It goes and it's 21%, and then it's 11%, but it's still consistently growing. Okay, next I want to focus on, I think they have enough revenue diversification. The debt rating, right? Debt rating, where is my page? Which page? 38. Okay, it should be in page 41. I want to see their okay, where it's gone. Let's see. Okay, the debt. Oh yeah, this one I want to see. So I want to see, okay, if they have a liability, right? What is their, right? The Moody's, S&P's, these are the debt ratings company, right? So they rank their debt to triple A minus and A, which is the senior level debt. So when I see this, I was actually I'm quite happy on that one. Even on the short term debt rating, even if the companies want to raise debt, it's A1 plus and A1 plus and T1, right? So it's also the senior level. So this means they can go and they don't have to pay high interest expense to pay to pay the for the high interest rate, right? Because the debt rating is quite good. And we know from the equity perspective, right? Equity shareholders only get paid once the debt holder get paid. If there is a low cost to the debt holder, this means we pay less to them, and equity shareholder will get their dividend and other shares. So that's pretty good. So that's what I want to show there. And also I want to show this note 8. Let me search, rather just to save time. Yeah, this is the, so here they have the long-term debt details, right? So no debt is due anytime soon. Okay, so you see here this one is due in 23, 26, 41, 40, and long time. In Japanese yen is due in this year, right? So this is due this year. This is yen, but if you see the 3.4 billion is the total fair value of their total debt, and the maturity of the debt in the what they need to pay through 2020 to 24, it's mentioned here, right? It's 6 million, 3 million, 500 million, and so this means 20, 21, 22, and 23, right? So 23, which is this one, they're saying that they need to pay 500 million, right? Which is in a few years from now. So this means at also from the long-term debt perspective, it's not due anytime this year or next year. So that's also the positive sign. And now one another important point I find, yeah, so you see here they put a statement that no customer account for 10% or more in their net revenue in this previous past 3 years. So this means they are very well diversified in terms of their customer, in terms of the revenue, and there is clearly mentioned in their 10K as well. That is very good. So this means even if one one of the customers failed is only affect the 10% of their revenue. So this means the company is pretty solid in terms of the fundamental analysis. It's not bad as well, right? So that's what also I like about it. And now if I go back, and if we compare, they also show here the 5-year cumulative total run index as compared with S&P, the broad-based index. So while comparing to the others, we know they are on the top, right? So this is the Nike, and this is S&P 500 and Dow Jones. I know. So even from 2014 to 2019, so they are doing pretty good. So in terms of others, okay. So in terms of their sector index, luxury goods and footwear, Dow Jones footwear index as well. So a little bit better as compared to Dow Jones US footwear index, but still better, right? Which makes sense. And so this is a pretty good market cap company. So that's pretty much. I think I haven't missed anything. Let me double check. And I think that's one of the good product. So if need to invest, so I already have, based on this analysis and my judgment, I have invested a little bit of my portfolio to this stock, and so far I don't give much focus on what's up, because we know these are already discounted securities. So for sure within 1 or 2 year I think it will come back, and it's doing good. The good thing is it's already started doing the direct selling to the customer and doing the good job. So that's pretty much my analysis. And last but not the least, if you like this video, please do share, give thumbs up, subscribe to my videos, and like it. And if you want to me to analyze any other stocks or share, please put in the comments, and please do give thumbs up. And thank you for watching this video.